Hello, Jen here. Today for our real estate exam prep, I'm going to go over 3 key terms and concepts that we need to know for our exam. That's mortgages, deeds of trust, and promissory notes. Why is a deed of trust always so hard to remember? It won't be after this video. I like to break concepts down and make them as simple as possible and super easy to remember with little tricks and acronyms and phrases. So if that's helping you guys as well, hit the like button and subscribe, and let's dive in. So for our real estate exam prep made simple today, we're going over those promissory notes, mortgages, and deeds of trust. You will not forget how these work or their differences after we break them down in this video. And just in case you don't watch the whole video, here are the acronyms of vocab we're going to be going over. So at the very least, screenshot these, read through these acronyms, see those vocab terms. I'm not going to go over them right now because I'm going to in these next few slides. So let's start with the OREE rule. This is a great little silly song from Prep Agent that will be super easy to remember when taking the test because we're going to see a lot of mortgagee, grantor, grantee. So the easy way to remember the difference is grantor, lendor, optionor, vendor makes me the giver of the proprietor for your pleasure. Grantee, lendee, optionee, vendee gives me property, makes me happy. Apologize, I'm not a singer. So the OR is the person who performs the action, and EE is the recipient of that action. A vendor sells to a vendee. A grantor conveys property to a grantee. So now that we have that covered, let's talk about mortgages. Mortgage is pledging property as collateral for a loan. It came from the English common law. They made the term mortgage, which literally stands for death pledge. Nowadays, we have multiple different types of mortgages and loans. There's conventional, fixed rate mortgage, interest only mortgage, adjustable rate mortgage, that's those ARMs, ARM, FHA loans, VA loans, combo piggyback loans, balloon, and jumbo loans. I'm not going to cover all of those in this video today, but I will cover a conventional loan or mortgage. This is one of our acronyms. So this is a home buyer's loan that is not offered or secured by a government entity. It is available through or guaranteed by a private lender or the 2 government-sponsored enterprises, Fannie Mae and Freddie Mac. So we can definitely dive into that in another video. But right now, just remember, if you see the word conventional in a question or as part of multiple choice, what do you generally need for a conventional loan? GAS, G-A-S, good credit, afford the down payment, and steady income. So those are the 3 things you need for a conventional loan. Good credit, afford the down payment, steady income, GAS. Easy peasy. So you get a conventional loan and now own a house with a mortgage. Awesome, but do you not have ownership rights since your property is the collateral for the loan? So this is where the vocab term that will come from our exam, this is where hypothecation comes into play. And that'll be the last time that I say the word wrong or pronounce it wrong, because from now on, remember hypothecation. Hypothecation is an asset used as collateral for a loan without giving up, P-O-T, pot, your possession, ownership rights, title. So super easy way to remember that. It's when you are giving up something for a loan, or when you're giving up, let's say you give your property for a loan, but you're not giving up possession, ownership right, title, hypothecation. So the property is still pledged as collateral to secure the loan, but without giving up that title, possession, or ownership rights. So however, the lender can still seize the asset if the terms of the agreement are not met. So for example, a rental property may undergo hypothecation as collateral against a mortgage issued by a bank. While the property will still remain as collateral, the bank has no claim on the rental income that comes in. So the person that owns the property is still going to get that rental income they're making. However, if the landlord defaults on the loan, the bank may seize the property. So you still own the place, you still have all your rights, but if you don't make those payments, then the lender can still take over that property. So that's mortgage with hypothecation. And a mortgage has 2 parties with the mortgage, a lender and a borrower, or a mortgager and a mortgagee. So a defiance clause, after paying your mortgage in full, freedom at last, the defiance clause defeats the lender. Defiance clause, defeat. Dramatic way to explain it, but it's easy to remember. So that means that the title is given to the borrower and they no longer have a pledge over you. Once you pay it off, you get the title and the lender no longer has that pledge over you. So remember, defiance clause defeats the lender. So a mortgage has two parties and a deed of trust has three parties. This one, for some reason, was always difficult for me to remember, so I created an acronym, deed of trust. Remember, BLT, BLT sandwich. You have your borrower, B, who's the trustor, your lender, who's the beneficiary of the trust, and the trustee, who holds the title. So deed of trust, BLT, a borrower, a lender, and a trustee. There's three parties versus a mortgage where there's just two parties. So a deed of trust is a type of secured real estate transaction that some states use instead of mortgages. It is essentially an agreement between a lender and a borrower to give the property to a neutral third party, the trustee, who will serve as the trustee. The trustee holds the property until the borrower pays off the debt. During the period of repayment, the borrower keeps the actual or equitable title to the property. The trustee, however, holds the legal title to the property. So it's used instead of a mortgage, and essentially it's an agreement between the lender and borrower to give the property to a neutral third party until the debt is paid off. So we have our deed of trust, BLT, you have the borrower, the lender, and the trustee. The trustee is holding on to that title until the debt is paid off. And then we have our promissory note, and this is simply a promise, promissory, easy to remember, just like defiance, defeats, promise, promissory. So this is a promise to pay a loan and evidence of that loan between the mortgager and mortgagee. So it also states, the promissory note also states all the terms of the loan, the interest rate, the amount borrowed, the consequences of not paying, etc., etc. So promissory note, that promise to pay. So what's the difference between these three? A promissory note is basically an IOU to the lenders that contains the promise to repay the loan. And then the mortgage or deed of trust, or BLT, is the document that pledges the property as security for the loan. So it is the mortgage or deed of trust that permits a lender to foreclose if you fail to make the monthly payment or breach the loan contract in some other way. So you either have a mortgage or a deed of trust, depending on the state. Mortgage has two parties, deed of trust has three parties, borrower, lender, trustee. And what is a promissory note? It's just the IOU, the promise to pay. So this slide pretty much has it all. It's pretty simple once you break it down. So like I said at the beginning, I like to take all this information, break it down, make it simple, and make ways that are easy to remember because it is a lot of info we have to know. So I hope this helps you guys in your studying. Best of luck with your continued studying and have a great one, you guys.